I recently purchased my second property earlier this year. I paid $862,000 for it, which might seem like a lot of money because it kind of is. However, I was prepared to make this purchase, and to add to the situation, I have since optimized the loan to make sure that it is working in my favor by reducing my interest repayments over the life of the loan as much as possible to save tens of thousands of dollars in the long run. And today I'm going to explain just how I've done this. Welcome back to my channel. My name is Reese, and in today's video, I'm going to be going into detail about the two types of loans that I have for my properties, how I've structured them to maximize the amount of money I save over the life of the loan, and I'm going to talk a bit about the tax benefits I receive based on the type of debt that I have. And the aim of today's video is to provide context about the benefits that some people will be eligible for when they owe large sums of money to a bank. There is a silver lining to having debt, and it is that if you make that debt work for you, the outcome will see you build wealth quickly over time, especially as the compound effect starts to take place. Now, before I really dive deep into the specifics of today's video, I just wanted to mention that I've left links in the description down below to other videos I have made on other topics that I will probably touch on throughout this video. So if I say something that doesn't make too much sense, chances are there is a video linked in the description which will have a more in-depth specification, explanation, a video that I've made on those topics. Feel free to use them as a resource. Hopefully they provide some value if I touch on something that doesn't make too much sense right now. You'll understand what I mean as we get into it. And now would be a really good opportunity just to quickly hit that like and subscribe button. It really does help the channel grow. Okay, so let's start this deep dive off by being nosy. Let's see what I am working with. At the time of recording this video, I am sitting on about $1,080,000 of debt, which is split between two properties. The size of the loan on the property that I purchased a couple of years ago, being my first property, has been adjusted now to about $400,000, and the amount outstanding on the new loan, the house that I've just purchased, is sitting at roughly the $680,000 mark, which when you add them up equals $1,080,000 of combined debt. Now, in regard to my first property, I just mentioned that the loan has since been adjusted. All this means is that I've borrowed money against that property to contribute towards the purchase of this new property. So I've increased the size of that loan to kind of reduce the size of this loan. And there is a reason as to why I've done that. Simply put, I used the equity in my first original property to reduce the size of my new property so that both of them would be under 80% LVR, which means I could avoid paying LMI. Now, if you don't know what LVR and LMI stand for, that's lender's mortgage insurance and loan to value ratio. Again, links are in the description on the videos where I've covered them extensively. For now, just understand that I've done it to keep my LVR under 80% on both properties to avoid paying a insurance basically, or a fee that I would never be able to claim on tax, and it's not beneficial to pay LMI in the long run. So that's context for both properties' loan amounts. Now let's get into the more clever aspects of how I'm handling this debt. I am not intending to live in the property that I have just purchased for some time, which means that this property is going to be an investment for the time being, which means that it's going to be rented out, which means that it's going to generate income, which means that I'm going to be able to deduct the interest component on the loan against my taxable income. This is known as gearing here in Australia, where the government allows you to claim the interest component that you would need to pay to the bank on that loan against your taxable income to overall reduce your taxable income, meaning you pay less tax to the government. And again, if you're unfamiliar with the topic of negative, positive, or neutral gearing, I've left the link in the description below to the video of me covering that topic. Moving on. The point that I want to make about this property though is that because I'm not going to be living in it, and because I pay a lot of tax to the government based on my other income sources, I want the debt on this property in particular to remain as constant as possible while I focus on paying down other forms of debt that I have, which might not allow me to claim the same benefits in terms of tax deductions against my income. It's kind of like a hierarchy, what comes first, and this is last on my list. So what I've actually done for this new property is fixed the loan as interest only for 2 years, which means that the amount owed, that $680,000 owed to the bank on it, will not reduce whatsoever for the next 2 years. However, I will still be paying the interest component owed on that amount. So after those 2 years pass, I will still owe $680,000 on this property, and I will have paid about $40,000 in interest to the bank across those 2 years, worked out roughly on a 2.8% interest rate. Meaning I will be able to claim about $20,000 each year against my taxable income while it's fixed interest only, which is the next 2 years. Now I'm going to move on to the other property just quickly. Just understand that there are other benefits to fixing a loan as interest only in my setup, and I'm going to explain what those benefits are later on in this video. But first, I wanted to go back to property number 1 to give the context of the setup there as well. So like I mentioned earlier, property number 1 is now owing about $400,000 to the bank on it, and I've split the loan into 2. And this is where it's important to understand what I've done. So if you're scrolling on your phone, put it down for a second and pay attention. We're starting with, I have split this $400,000 into 2 separate loans. I have fixed a portion of this loan as interest only for 2 years, very similar to the other property. However, I've left the remaining sum as principal and interest variable, meaning the interest rate can fluctuate and I'm paying off principal, not just the interest owed on the money that I owe the bank. And the only deciding factor as to how I've split up this fixed interest only component with the principal and interest component is completely and solely based on how much money I'm going to be able to save in my offset account, how much I'm going to be able to build that account up over the fixed term. So for over the next 2 years, how much money am I going to be able to put into my offset account? And the main thing to understand here is the amount I set as principal and interest should never be below what I'm able to save over that period of time. So as an example, if I could put $100,000 a year into my offset account, I should make sure that over that 2-year period that I have the principal and interest component set higher than $200,000, because year number 1, 100,000 goes into the offset. Year number 2, another 100,000 goes into the offset, which makes it 200,000 in that offset, which means as long as the principal and interest component is set higher than that amount, I'm going to be good. It means that the money in my offset is offsetting the loan, and the interest only component is just set there so that I'm able to save into that offset much faster at a much quicker rate. It's beneficial to do it that way, which I'm going to explain why just in a moment. Now, everything I've just talked about is a little bit confusing, absolutely, but I'm going to break it down into a simple example with the actual numbers to explain it exactly, because the outcome when I go through the benefits should give clear context as to why you would consider setting your loan up this way over the long term. So we're still talking about property number 1 where I owe $400,000. I worked out that I can build up in my offset over the next 2 years about $200,000, or I can get it to about $200,000. That's not me saving $100,000 a year by any means. I've got a little bit of cash remained over in my offset account as is after the purchase. But what I'm trying to explain is I can get that to about $200,000 based on my projections, because I make videos talking about how I plan to save based on my income. I know what's coming in and I can project and estimate ahead. I'm planning to get to about the $200,000 mark within the next 2 years. So what I've done is I've set the principal and interest component just a little bit higher than $200,000. I've set it at $210,000, which means I've set the fixed interest only component at $190,000. So if you add up $190,000, $210,000, you get the total combined loan of $400,000. Okay, you now have full context about the setup of all of my property's debt. Now let's talk about where I benefit from the way I've set it up. Number 1 is that $1,080,000 of debt is a lot of money to owe a bank. I do not care if interest rates drop any further. I am able to make my repayments very comfortably as they are right now. However, if interest rates rise, which there is a lot of stigma around this eventual rise of interest rates coming, I don't want that to happen. I want to negate that from happening as much as possible. So having components of my loan fixed for a period of time in my books is a safe play. Fixing the loans for a 2-year period at a time also means I'm not paying the principal component on that money. What I'm doing with that money is putting it into my offset anyway, which is benefiting me by allowing me to build savings while still offsetting money I owe to the bank. It's the same scenario again, it's the hierarchy of what is the priority debt to pay down first. And having fixed components is fine if I'm focusing on principal and interest components elsewhere by building up an offset account, which again, if you don't know what an offset account is, link is down in the description below. Everyone should understand what an offset account is. It baffles me that people don't have that understanding. Anyway, having access to liquid cash in my offset is going to be much more beneficial in the event where an unexpected expense comes up versus having it locked up in the loan. If I decide to get married and want to pay for a wedding, if I want to furnish a house, if I have a child one day and need access to a little bit more money, just while I can adjust my bills and things like that, having access to that money is going to be much more beneficial in an offset, and it's essentially still doing the same thing as if I was putting it extra into the loan. Ultimately, having a buffer will allow me to solve these problems without increasing my stress levels in terms of my finances. The second benefit comes by not paying off the good debt. The debt that is working for me, I don't want to pay that off unnecessarily. I want the debt that I'm able to claim as a tax deduction to remain as consistent as possible while focusing every other dollar on what I call bad debt. Bad debt in this context is debt that I cannot claim against my taxable income, and by fixing these loans for a period of time allows me to keep it constant. Number 3 is that I want to have as much liquid cash in my offset. I'm talking past the buffer zone now. I want as much in that account as I possibly can, rather than it being tied up in the mortgage if I were to be making extra repayments, if I didn't have a redraw capability, or it was just a principal and interest loan for the length of the loan, i.e. it's literally absorbing the money every time I make a repayment. I can't redraw that and it's not in my offset. The money is much better in my offset right now than it would be against the loan. The reason for this is because having that debt while it's rented out is always going to be a tax deduction at the moment based on the rules of Australia. And having access to $1 million in cash allows me to have options. I can go on holidays, I can buy new cars, I can build a new house without having to worry about borrowing money from a bank, applying for those types of loans. The loans are set up over 30 years based on minimum repayments. They will pay themselves off. Yes, I'll pay a shit ton of interest, but if I'm smart about it and I keep enough money in my offset to make that amount owed negligible, as in I've got $980,000 in a bank account on $1 million debt, no problems. That means I'm only paying interest on $20,000 a year. At 2%, it's not a lot of money. Now, these might seem like small benefits, but when you really crunch the numbers, which I'm about to give you a specific example based on what I've calculated, you'll see that over a long period of time, it's going to be quite significant in many different ways. Now, like I said, I've actually done the math. I've calculated how much additional money I will be able to save while the loan is fixed over the next 2-year period. This is just a 2-year period, and based on all of the tax benefits as well as what I'm not going to be putting into the loan as principal, I will have an extra $70,000 in my account at the end of this 2-year period, which will be liquid cash ready to go for whatever I need it to do, while still doing the exact same thing as if I were to put it into the loan as principal. That is not an insignificant number, and that is over the course of 2 years. Imagine over the course of 30. When that 2-year fixed term is up, I will do the exact same thing again. I will calculate how much I'm going to be able to save over the next fixed period that I intend to fix it for, whether it's 2 years, 3 years, 5 years. The general consensus for a fixed loan as interest only is between 1 and 3. I've seen them go between 1 and 5 before as well, but I'll do that calculation. I'll work out how much I'm going to save, and then I'll fix the portions that I can't save against those loans as interest only again, rinse, repeat. I'll keep the new purchase if I'm not planning to live in it at the time as try and keep that debt as consistent as possible while I focus on paying property number 1 off. And I'll probably make a video updating how much I plan to save over that period of time, which again should be significant while the debt is still very high. And I will continue to do this until that $1,080,000 of debt is fully offset, while slowly chipping away at them, reducing the amount of interest I pay to the bank effectively to nothing, whilst having access to liquid cash to do whatever I need to do with it. Also keeping in mind that property generally is an asset that goes up in value over time. We've seen that happen non-stop basically forever, especially as countries like where I live, very fortunate to live in Australia. The properties here generally are going to go up because people want to come here. There's a very good way of life here in Australia, and I can see people coming here, not necessarily leaving, driving the price up as more people need a place to live in a place like South Australia where I live. Now, if you've made it this far into the video, this should paint a pretty good picture as to how very wealthy people who are into property make a lot of money in terms of their tax deductions, their asset building, their wealth building processes. This should be a very simple explainer of how someone would go about setting up a loan, which might realistically, it's taken me a couple of weeks to set up the loan how I wanted to work to set it up like this. It hasn't been too difficult because I understood what I wanted. And once it's set up, it's set and forget. For that 2-year period, I don't have to think about it. Then I spend a week and 2 years to rinse, repeat, and I do it forever until the point is where I go, all right, I can fully pay off these loans. I can build a new house. I can do whatever I want to do. Super important to understand what I'm explaining, especially if you plan to get into the property market in the future. And I highly recommend understanding topics like this because you want your money to work for you. And when you really do the math over a 30-year period, we're talking about saving hundreds of thousands of dollars, not tens of thousands, not thousands, hundreds of thousands of dollars by the end of it. I am tracking all of it in my spreadsheet, and by the time I get to that 30-year period, let's say I'm still making videos, I'm going to look all the way back to this one hopefully and go, holy crap, I saved $330,000 over that period of time. Plucked a number out of thin air. But my point again being is when you project ahead, you can see pretty clearly, you can get a pretty good idea of where these savings are going to be, and I project them to be in the hundreds of thousands of dollars over the life of the loan. And I don't think you're going to regret putting in the work now to get this understanding and to optimize your situation if it means that you're going to have literally a Lamborghini at the end of it. You have enough money to build a brand new house. You have enough money to retire with. It's not insignificant. Do the work now. Make sure you understand it, especially with purchases like this, because they're for life purchases. Like 30-year mortgages is not a short period of time. People locking themselves in for this period of time need to have a clear-cut understanding of what they're getting into, and they should be trying to optimize it. I preach it so much on my channel, and I think that it's now at a point where the videos I make kind of all intertwine and create this bigger narrative of how to optimize and set yourself up for success. Success is probably a bad word, to make progress in a way that is effortless, because it's a great feeling knowing that every year my money's working for me versus me stressing to pay my bills. Summarizing again, but I really want to put some emphasis on it, and hopefully in today's video I have explained it in a way that makes sense and something that you could definitely go away with and potentially ask your banker, ask people, how can I make this work for me? If you have any specific questions, feel free to drop a comment down below or message me on the about page of my channel. I'm definitely accessible and happy to answer any questions that I possibly can. And that's pretty much it for today's video. I hope you found it interesting. I hope you learned something, and I hope it was insightful. If it was, like I asked at the start of the video, please tap that like and subscribe button. I really do appreciate the support. And as always, I will see you in the next one. Bye for now.